Inflation just hit a 3-year high. The Fed just got a new chairman, and the market's response was to send Treasury yields lower. That is not normal behavior. And if you can explain why it's happening, you understand something most investors are currently missing. Here's the real question. When a new Fed chair inherits the hottest inflation in 3 years and still refuses to move rates, is that discipline? Or is it a message? What Warsh does next will set the tone for every rate decision through the end of this decade. Let's start with exactly what we know, because in a developing news environment, precision matters more than speed. As of today, June 16, 2026, the Federal Reserve is holding its rate-setting meeting. The first one, chaired by Kevin Warsh, who replaced Jerome Powell. Inflation, according to the reporting, has reached a 3-year high. The CNBC Fed survey indicates that Warsh's Fed is not expected to make any change to rates at this meeting. Treasury yields fell ahead of the decision. And separately, the Bank of Japan just raised interest rates to their highest level in 31 years. That is the factual perimeter. Everything else in this video is analysis, clearly labeled as such. Now here is what makes this combination of headlines unusual. Normally, when inflation rises to a multi-year high, bond markets price in more rate hikes. That pushes yields up. The fact that yields are falling tells you the market is not interpreting this inflation print as a signal that the Fed will act aggressively. Instead, the market is reading Warsh as a holder, not a hiker, at least for now. The New York Times described Warsh as facing a tenuous balancing act. That framing is important. A new Fed chair walks into their first meeting with zero track record on the job. Every word, every pause, every vote, they all start to define how credible this Fed will be on inflation. Markets are not just reacting to today's decision. They are stress testing the new leadership. The actionable insight here is simple. Watch the language in the statement, not just the rate decision itself. In central banking, tone is policy. The conventional read on a Fed hold during rising inflation is paralysis. The more accurate read, given the current setup, is strategic patience. But those two things can look identical from the outside, and the difference matters enormously for where rates go next. Here is the analytical framework. Kevin Warsh is an economist and former Fed governor with a reputation for being hawkish on inflation, meaning he historically leans toward higher rates as a defense against rising prices. If you bring someone like that into the chair position, and he does not raise rates, when inflation is at a 3-year high, there are 3 plausible explanations. First, he believes the inflation reading is lagged data, and leading indicators he is watching suggest a natural cool down without intervention. Second, he is inheriting an economy where rate hikes would cause more structural damage than the inflation itself justifies right now. Third, he is waiting to establish his own data baseline before acting, so that any future move is entirely his own signal, not a continuation of Powell's playbook. Any one of these is defensible. The market's response, yields falling, suggests traders are pricing in the first or third scenario. They do not believe this Fed is about to embark on a new rate hike cycle. Here is what this means analytically for portfolio positioning. A flat rate environment with elevated inflation is a very specific macro regime. Real yields, that is nominal yield minus inflation, compress in that environment. Historically, compressed real yields have been supportive for hard assets, commodities, certain real estate structures, and yes, Bitcoin, which we will get to in a moment. This is not a recommendation. It is a description of a historical relationship. Understand the regime before you make any tactical decisions. Here is the thread most domestic-focused investors are missing entirely. The Bank of Japan just raised interest rates to a 31-year won. And Bitcoin rose on that news. That connection is not accidental. It reflects a global capital dynamic that has been building for months in 2026. For decades, Japan maintained near zero interest rates, which created something known as the yen carry trade. Investors borrowed in cheap yen, converted to dollars or other currencies, and deployed capital into higher-yielding assets globally. When Japan raises rates, that trade gets more expensive to maintain. Some of that capital unwinds, which typically strengthens the yen and creates volatility in assets that benefited from the carry trade. So why did Bitcoin rise on a Japan rate hike? A few analytical possibilities worth considering. 1. If the carry trade unwind pulls capital away from dollar-denominated assets and creates uncertainty about traditional safe havens, some investors may rotate toward non-sovereign alternatives, assets that are not directly controlled by any central bank's interest rate policy. 2. The Japan hike reinforces a global narrative that the era of free money is definitively over, which paradoxically can increase demand for fixed supply assets as long-term hedges. 3. The Bitcoin move may simply reflect short-term correlation with broad risk sentiment, which is a much less interesting story. The larger point here is this. In 2026, you cannot analyze the US Fed in isolation. The Bank of Japan, hitting a 31-year high on rates, while the Fed holds flat while inflation rises in the United States. That is a global macro divergence. Divergences create capital flow opportunities and risks. The investors who map those flows before the crowd are the ones generating alpha. Everything else is just reacting to yesterday's price. This is not financial advice. It is a framework for how professionals read the global board. We opened with a question. When a new Fed chair holds rates at a 3-year inflation high, is that discipline or a message? Based on everything we covered, the honest answer is, it is both. And the market has already made its bet on which one matters more. The follow-up question, which will define the next 6 months, what does